We're here today to talk to Bill Longbrake, Executive in Residence for the Center for Financial Policy. He writes a monthly letter called the Longbrake Letter that discusses macroeconomic issues. Today we'll discuss the topics he talks about in his February letter. In this month's letter, you address certain imbalances that could create significant consequences if not dealt with. The two primary ones are the debt leverage and the currency, policies, and trade. Could you please provide some color around these imbalances?
Certainly, I'll be glad to talk about it. Usually, we focus from day to day on short-term reports, like the report on housing prices that came out recently from the Case-Shiller, or inflation, or the employment report, and there's a lot of commentary and talk about it. We focus less on long-term trends and developments and things that can build up over time and eventually create considerable consequences if they're not addressed. An example of that would be the meltdown that we went through in 2008 and 2009 as the mortgage market collapsed, the housing bubble burst, and it was traceable directly to too much debt in the economy and egregious practices in underwriting. Well, that problem of debt is still with us, but it has moved from the consumer to the federal government. If you look in my report, you'll see some graphs that talk about the total amount of debt in the U.S. economy, and the different sectors are the consumer, business, and government. Those are the three major ones. And the total amount of debt has actually not changed. It's actually at a very high level. It hasn't gotten any better. But what has happened is the debt has moved from the consumer sector over to the government sector. Now, an imbalance, if it's not addressed over time, and indeed, in fact, if it gets worse, and that's a concern here at this point, then eventually it will have a day of reckoning and a day where it gets corrected. The other imbalance that I talk about in this month's letter has to do with foreign international trade. And simply put, there's two sides to that coin. One side is the U.S. is running a trade deficit that's in excess of 3% of gross domestic product. That's very large. It's not as large as it used to be, but it's still very large, and unfortunately it's growing again. On the other side of that, China is running a huge trade surplus. And what that does is it creates a shift of resources from the U.S. to China. And if that's allowed to continue indefinitely, and in fact, if that imbalance builds, it will have the same consequence in the long run as the debt building, in terms of it's just not a sustainable outcome. And at some point, there will be a correction. And the longer it takes before that correction occurs, the more likely it is that it's going to be explosive when it finally does occur.
Thank you, Bill. Let's first discuss the debt leverage. In order to address the debt crisis, you talk about the need to do more than just tinkering with discretionary spending, but to overhaul the tax structure and restructure entitlement programs. A bipartisan group of senators are developing a plan that will do just that. Can you please comment on the creation of the bipartisan group, its goals, and your expectations?
So let's first of all just frame the issue a bit, Eric. We're focusing here on the 10% federal budget deficit and the fact that the total debt to GDP ratio is now at 63% and it's headed north. And so the whole discussion that's going on currently in the U.S. Congress is about how do you get spending under control. But if you want to look at the full sources of what affects the public debt to GDP ratio, there are three things that you have to take a look at. Spending is one of them, and that is where the focus currently is in the Congress, but it's only one of three. The other two are the tax structure, and we can think of that as changing the taxes that you pay, but more properly it's talked about as this tax structure because it would have to do with deductions that you can make and tax rates and a whole variety of things. And then the third category is the entitlement programs. And we know those very well. They're Social Security, Medicare, and Medicaid are the three principal ones. And what we also know that the current track that the entitlement programs are on is that the benefits will grow over time, the funding sources will not, And as time passes, essentially those plans will go bankrupt. And the only way currently, if nothing is done, is they will end up getting funded by issuing federal debt. So those are the kind of the three things. Now let's come back and talk about what's going on in the Congress right now. You mentioned the senators, but to frame this, we need to start with the House of Representatives. So the House of Representatives recently passed a resolution called a continuing resolution that would extend funding of the fiscal year 2011 budget. So that started on the 1st of October last year and goes through the 30th of September this year, from now through September, but at a rate that would cut expenditures or spending by an additional $60 billion. That's already been passed by the House. The Senate has not acted on that. On March the 4th, the current continuing resolution expires. And if nothing is done on March the 4th, then the government can no longer make expenditures of any sort because there won't be any authorization to do that. So what happens after March the 4th? Well, before I get to answering what happens after March the 4th, there's a second piece to this story, and that has to do with the federal debt ceiling, which is part of the story, but it's on a separate track from the continuing resolution. The debt ceiling really limits the amount of money that the U.S. Treasury can borrow. We're very close to maxing out that limit right now. The current estimates is that the Treasury will run out of money sometime in May, possibly early June. So there's a little time here to play with yet, but eventually the debt ceiling has to be raised, and eventually, or by March the 4th, the continuing resolution needs to be extended. So now what's going to happen? Well, you've got the House has already passed the continuing resolution. The Senate, as you mentioned, has these, there are 6 senators actually who are working together, and it's a bipartisan group right now, who actually believe that focusing only on spending cuts alone is not adequate, that you should also right now be focusing on entitlement programs, because that, after all, is a very serious long-term problem. So we'll see what happens, because now you've got the political process in play with the House on one course. The Senate may be on another course, although it's not clear at this point that 6 senators represent the consensus of the Senate. What's most likely to happen is that March 4th will come and there will be not an agreement between the House and the Senate. But rather than let the government shut down, very likely there will be a 1 or 2 week extension of the continuing resolution, and that process most likely will continue with a lot of discussion and a lot of arm waving and so forth until the federal debt ceiling really becomes binding, because that one will absolutely force a final decision. And what I think will likely happen at this point is that you will have a combination of raising the debt ceiling and passing the continuing resolution combined into one initiative. Probably will happen sometime in May, maybe as late as early June. And it will for sure include spending cuts. Probably not as much as are in the current House resolution, but still spending cuts. And we will see if they contain anything else beside that. You know, I'd like to add another comment, because I'm rather pessimistic in the letter about the Congress addressing the tax structure or the entitlements, that the focus seems to be politically right now on the spending. And I would be very happy, delighted if there was a serious attention to entitlement programs, but I do not at this moment see the broad enough political consensus to get there. So my current expectation would be, yes, you'll have spending cuts, you'll ultimately resolve this problem after a lot of noise, but you won't have anything beyond that, and therefore the imbalances in the public debt will continue to be a problem that builds.
Well, on the global front, let's talk about the second imbalance, currency policies and global trade. In your letter, you discuss the tendency of trade surplus economies to overheat. One such country is obviously China. On Thursday, the Chinese central bank released new data that showed an increase in hot money, or speculative investment chasing short-term returns. Why are investors so keen on short-term investing in China?
Well, let's again give you a little background on that. First, a quick question: why would investors want to invest in China? Well, China pegs its currency to the U.S. dollar. So if you're an investor and you look at China as an investment, you don't have to worry about currency risk. It takes one risk off the table. The other thing that we all know very, very well is that China is growing at a rate of close to 10% after inflation on an annual basis, 3 times or more of the rate of growth in U.S. and in other developed countries. So if you're an investor, you're trying to get the best return with the least risk. And if you just look at it in that very simple way, China looks like a great deal. All right, now let's go a little bit further and dig into that. China is following a dollar pegging policy very intentionally, because by doing that and having a cheap yuan relative to the dollar, they can actually produce goods that are cheaper on world markets than can be produced in other countries. That then creates jobs in China, and they need to create those jobs because there's kind of huge pressure to employ a population that's migrating from agricultural areas into urban areas. But what that does then is it creates this huge trade surplus. And you've got 2 things going on. You mentioned the short-term flows from investors, but that's just chasing the good returns. But you also have, because of the trade and dollar pegging policy, huge amounts of resources coming into China way beyond and significantly beyond just the short-term investment flows. So where are those dollars going? Well, the trade surpluses are going primarily into infrastructure building in China, both in the urban areas but also in the rural areas. Some really fantastic projects have been done, but that in turn is consuming commodities, cement, steel, copper, anything that you can think of that has a commodity on a global basis, and it's one of the principal drivers of the inflation that we've been seeing recently in commodity prices. On the short-term flows, that's unfortunately going into more speculative investments for quick returns. And in the case of China, a great deal of it's going into the property market, so that there's been considerable inflation in property values. The risk long term in China is that these investment dollars, they're actually building far more capacity than can be put into use productively at the current time frame. How long can you continue that? Eventually you have to get it into some kind of productive state. The speculative flows pumps up prices, creates a price bubble, and we know what happens eventually when price bubbles burst, not pretty things. So China has a bit of a challenge there, but understand that there is a rationale behind the main policy, which is to create jobs and to accelerate the rate of growth in China.
What policies has the Chinese government implemented to slow down the type of speculative investing?
Well, China's done 2 things that are familiar to everybody. One is they have raised interest rates, so that would be monetary policy, try to raise the cost of borrowing. Second thing they have done is to raise reserve requirements in their banks. And what that does simply, and they've actually raised them an enormous amount. And that is intended to discourage or reduce the amount of new lending that goes into the Chinese economy, because you have to have a larger amount of reserves for each dollar of loans. The other thing that's not much talked about, and it's sort of quiet behind the scenes, and it's a way in which the Chinese political system works, is that the economy is dominated by the state enterprises, which are large state-owned corporations, and it's essentially run by an oligarchy. But there, they can also use that political leverage to just kind of slow down or direct the directions in which the investments and how the money is spent overall. One of the things that's done in some economies, but it's not on the agenda for China, and I doubt that it will be, is to put in place capital controls. And capital controls simply are you do not permit certain types of money to come into the economy. That would be, if it's used, would be probably most likely directed at speculative investment inflows.
In your letter, you emphatically report that inflation is not a threat now and will not be for some time to come. How can you say this when global commodity prices are currently so volatile?
So what I'm talking about when I say inflation, I'm talking about U.S. inflation, all right, because there's inflation in China has been ramping up, in Brazil it's been ramping up, in Europe it's been increasing and so forth. In the U.S. actually it's pretty well under control. You know, another comment I would make is that when you talk about inflation, we need to distinguish between core prices and total inflation. And commodity price inflation, which is very visible, it's like the price of oil, and the price of oil is going straight up at the moment because of the Middle East problems, particularly in Libya. And that'll eventually go into gasoline prices at the pump, so it's a highly visible price. The other thing that's been happening in recent months is food prices have been going up quite sharply. Although I did notice recently rice prices in China have turned down, so maybe we're at that cusp where things are beginning to turn. But food and energy prices are subtracted out of total inflation measure to get to the core measure of inflation. And the reason that's done is that food and energy historically are very volatile prices. They're subject to changes in weather, to political events. They go up, but what we now know from research that's been done is they usually eventually come down. And so the real question is what happens to all the other prices, or the so-called core index? Do they move up to meet the shocks in energy and food prices, or do they stay down? And what the research shows is since the mid-1980s, so that's a 25-year period, what has happened is every time you have an oil price shock or a food price shock, the core prices do not go up. Eventually, the food and energy prices come back down to the core prices. So first point is focus on the core prices. And just to add a little bit of authority to that, that's what the Federal Reserve focuses on when they do monetary policy. So when they talk about keeping the inflation rate under 2% as a policy objective, they're talking about the core rate of inflation, not the total rate of inflation. So now, why would I say the core rate of inflation is not likely to go up? Unemployment is 9%. Wages are not going up. Actually, they've been going down. Productivity is being very strong. There is no bargaining power in the labor market. And historically, when we look at inflation, you don't have it sustainable for any length of time unless you have wage rate inflation, and there is none at the moment. So commodity prices by themselves, small fraction of the total price picture, a temporary shock, yes, highly visible, could affect people's expectations, but at the moment, all the indicators of inflation expectations are well behaved, or as the Fed says, well anchored, and there's no indication that inflation is likely to break out anytime soon when you go back and look at all the problems that the economy is still facing and the fact that core rates are still very low and well behaved.
Well, thank you very much for that explanation. Can you give us a little preview of what's going to be in your March letter?
Well, I can do that. It isn't written yet, so I reserve the right to change my mind. But what I usually do is look at what's going on in the economy and then adjust the topic of the month to fit what's being much talked about. But what I did put at the end of this month's letter, there's a little paragraph as I talked about a book called The Lords of Finance that's about the period from the late 1800s up to World War II. And the Lords of Finance are the governor of the Bank of England, the president of the New York Federal Reserve Bank, the head of the Reichsbank in Germany, which is what it was called, it's called the Bundesbank today, and the head of the Bank of France. And this was in the period from World War I up through the early years of the Depression, or about a 20-year period. The point of talking about history is to go to another period in time where imbalances were allowed to build up and eventually exploded and created dire consequences, and then to see what parallels, if any, or what lessons there might be for us in our current situation.
I look forward to reading it. Thank you very much, Bill.
You're welcome.